How is interest income taxed on you and how can you avoid it? In this video, I'm going to run through everything you need to know about savings income as a UK taxpayer, the reliefs that are available, how to minimize it, and ultimately how you can keep more of your hard-earned savings money. For those that don't know me, my name is Joshua Tharby, Chartered Tax Advisor, and I specialize in helping entrepreneurs, business owners, property investors legally keep more of their hard-earned money. So guys, welcome back to the YouTube channel. In this video, we're talking all about savings, interest, income. How is it taxed in the UK? What reliefs are there and how can you get it tax-free? So the first thing we'll touch on is how is it actually taxed? Of course, interest income is taxed on you personally. You personally receive that interest income and it's treated as part of your total income. So whether you receive pensions, employment, business profits, rental profits, dividends, each of these is taxed in accordance. So the first thing that gets taxed is your employment income. Employment income, self-employed business profits, property profits, pensions, that's your first slice. So that's taxed, that uses your personal allowance. And then we've got savings. So savings income is taxed, and then dividends are taxed last. So dividends are often called the top slice. So they pay the highest amount of tax. Effectively, that's what gets taxed last and pays the highest amount. And the reason I'm kind of going into detail on this is because there's one massive relief or one exemption allowance that's available where savings income is your first £5,000 of taxable income. So that sounds a little bit complicated. So when we talk about taxable income, that's income after your personal allowance. So as you know, you've got a £12,570 personal allowance each and every tax year. You know, fingers crossed, someday soon that actually starts increasing, but it's frozen until I think 28, 29 at the earliest, and you know, God knows how long, how much further that will actually stay in place for. But so what will happen is if you've got a salary, for instance, a salary or a pension, and that uses up your 12,570 bang on, just to keep the example straightforward, and then you receive £10,000 worth of interest income. Well, actually, there are a couple of really generous reliefs that will apply here that will actually reduce that tax bill down that you'll be paying about £10,000 quite significantly. So the first £5,000 of taxable income, in this case, because you've got your pension and salary, pension or salary, that you can either or in this case, uses your personal allowance. So you've actually only got £10,000 of income, and that is savings income. You've got your £5,000 savings nil rate band that can apply. And this will basically give you a 0% tax rate on that interest income. So £5,000 completely tax-free. And then we've also got the personal savings allowance as well. That's £1,000 as a basic rate taxpayer. So we've got another £1,000 completely tax-free. So actually on that £10,000 of interest income, only £4,000 of that is taxable at 20%, £800 of income tax. Now that's not bad. So in this example here, you've had the personal allowance, assume pension income or salary, interest income there. So that's about £22,000 of income with only an £800 tax bill. That is very, very good. And it shows you the power of having interest income and how tax efficient it can be. Another great benefit of actually having savings income is there's no national insurance. When we look at employment income or business profits, they have the same rate of income tax as savings income, but you also have national insurance. And with dividends, of course, they're taxed at a higher rate. You've not got access to these lower tax bands, the savings nil rate band or the personal savings allowance. All you get is the paltry £500 a year dividend allowance. And using these allowances, if you've got £100,000, for instance, and you're going to get a decent return on that, 5 or 6%, you can still get these days. You can get that completely tax-free if you've got low-over income. And what I mean by low-over income is we spoke there on that example of having just £10,000 of taxable income. But if you say had a salary of £12,570, this is kind of more heading down the business owner route now as how you can benefit from these allowances. If you've got a salary of £12,570, you might have either interest coming in from the bank because you've got 100k sitting there, or you've also put 100k loan into your property investment or your business, your limited company, and you're actually charging interest on your director's loan to your company. Either way, whichever of those specifics you do, you've still got, in effect, £6,000 of interest income coming in. You could take that £6,000 of interest income, you won't pay any tax on it because of the savings nil rate band, because of the personal savings allowance, and then you top up the rest of your income with dividends from your limited company, which 500 tax free, the rest at 8.75% up to the 50,270. Well, actually, you've got an additional £6,000 out of your company without any tax to pay at all, and it's tax deductible in your limited company. Or if you're a saver, you've got it tax free, and that's still a great result. So actually, utilising interest income and planning around this can be very powerful when it comes to accumulating income with minimal taxes. If you want interest income without any tax to pay at all, the best way of having this is by using an ISA. Of course, there are talks in the media at the moment about cash ISAs potentially being scrapped or the limits reduced down to 4,000. But at the minute, the allowance is still 20,000 for interest income. So if you do have a lot of income coming in, especially if you're a higher rate taxpayer, you want that money probably in an ISA. Because as a higher rate taxpayer, you could be paying 40 or 45% as an additional rate taxpayer on that interest income if you just got the cash in your own name. Whereas if it's in an ISA, you can put £20,000 in currently, and that's tax free. And then what will happen is any growth and any income you get from the funds in that ISA are also completely tax free. For a lot of kind of people where you might be a basic rate taxpayer and you're not a high rate taxpayer, if you are flush with cash and you are invested, you're probably better off actually having your ISA used for stocks and shares in a lot of cases because the growth is a lot higher. But if it is income and you're a higher additional rate taxpayer, usually having a cash ISA where you're getting that savings income coming in, if that's part of your investment objectives and your investment for portfolio, that's usually the better approach. It's completely down to personal preference, but either way, £20,000 a year in your ISA completely tax free. So there we have it, guys. Everything you need to know about interest income, how it's tax efficient, and how you can utilise it to reduce your tax bill. Hope you find this video useful. Please do give it a thumbs up and smash that subscribe button. Until next time. Bye for now, guys.